We're trimming it a bit. I don't think we're on the cusp of going back and revisiting the lows. We do think the economy is going to firm in the back half of the year. We do think that a lot of the companies that have dominated the last 10 years, in the long term, this crisis may actually provide a tailwind. But absolutely, the market has run 30% off of the bottom. You have unprecedented uncertainty about the shape of the recovery, about the way the world's going to look when this all is over. So we've been cutting back, and really what we've been emphasizing are three things. In addition to trimming, we've been really focusing the portfolio on quality, names with fortress-like balance sheets, earnings consistency. We've been putting carry into the portfolio, and we've also been using elevated vol and selling it as a way to get some additional income into the portfolio. So really what we're preparing for is a few months, maybe longer, where the market's range bound, and a lot of what you want to do is protect on the downside and generate income.
Just want to hit some headlines that are crossing the wire that come from the Federal Reserve. They just released a financial stability report, just kind of looking at the state of the markets and some headlines here. The Fed is warning, and this goes along with the cautious tone we heard from Jay Powell earlier this week. Fed warning that COVID-19 outbreak, quote, poses severe risk to businesses of all sizes and millions of households. Warns that the banking sector may experience strains as a result of economic and financial shocks. Warns that the strains on household and business balance sheets are likely created fragilities that last for some time. They go on to warn, to talk about how credit spreads are relatively low. They talk about asset prices and also talk about the fact, Mike Santoli, that asset markets may be vulnerable here to the pandemic and the shock. It's something we've heard, and they sort of do these periodic assessments of the markets. But clearly, there's a lot of risks out there. Jay Powell made it clear that he's worried he can do more, and he's pushing on fiscal policymakers to do more as well.
Yeah, for sure. I mean, on some level, it reads as kind of a standard force majeure clause. Like if in fact things get a lot worse from an already bad situation, we're certainly not priced for it in terms of asset markets. And yes, it does kind of set the scene for the Fed having a posture of risk management and of looking to help if in fact there's these hazards kind of present themselves along the way. So I don't think it's really news to a market that's already seen all of these kind of consumer leveraged stocks get cut in half and all the rest of it. And credit spreads, yes, they're better than they were in March, but they're still elevated versus what you would consider normal levels going back to last year. So it's not as if the market has gone to sleep on these concerns entirely.
Charlie, where do you stand on the banks who've had a terrible week?
Sorry, Will, say it again.
Where do you stand on the banks which have had a terrible week?
Yeah, this is the one in another area like retailing, which I'm not really piling into here. I think it's very tough to make money with this kind of yield curve. I think we are going to have more defaults. Frankly, the banking business is just not a business where people have a lot of sustainable competitive advantages, so we would not be pounding the table on the banks. With some exceptions, Goldman Sachs trading at 75% a book would be one. Lazard, we think, is very, very cheap. There are exceptions, but the run down the middle bank, no.
I'll just hit one more of those Federal Reserve headlines from the Financial Stability Report, Russ. The Fed says asset prices are subject to significant declines if the pandemic worsens. Is the market right now betting that the pandemic is not going to worsen?
Yes, I think the market right now is discounting a recovery. We can all debate if it's a V. Well, it's certainly not a V. If it's a W, a swoosh, an L, but they're definitely betting on a recovery. And if you were to see a situation where states are forced to reimpose strict lockdowns, or we don't come out of them for months, and you're not going to get that second half recovery, the market is definitely going to trade lower on that. I think the good news, though, is the market is not expecting a V shape, and you see that in what's leading. If the market thought we were to come surging out of this, cyclicals value would be doing much better. The fact that secular growth is still leading tells you the market does expect a recovery, but a very uneven recovery.